This is part 3 of our chapter 3 recordings, where we're going to go over the specific adjusting entries for NetSolutions. So we'll see how the adjusting entries that apply to NetSolutions. What I'm displaying right now is the unadjusted trial balance of NetSolutions as of December 31st, 2013. In chapter 2, there was additional set of transactions for the month of December. I did not record those transactions, so you can take a look at them at the end of chapter 2, and this is the trial balance as of the end of chapter 2. Two things that I want to note. On December 1st, NetSolutions prepaid $2,400 in advance for insurance to cover for the next year, and early in December, NetSolutions received $360 rent in advance for renting out the land that they own that they are not using currently. So these are all the balances that we're going to begin with, and what I have done right now is I have taken those balances and I have posted them to the T accounts. So we see all the beginning balances in the T accounts. Now let's go and let's do the adjusting entries for NetSolutions. The first adjusting entry that we have on hand, is we took a physical inventory and we see that supplies on hand at the end of December is $760. So we go to the trial balance or the T account and we see that at one point we had $2,000 of supplies on hand, but right now it's only $760. So we have to do that subtraction that was mentioned in the second recording. We take the $2,000 of supplies that are on hand, that are in the account. We subtract the $760 of supplies that are on hand, and that equals the 1,240 supplies that are used, which is the amount of the adjusting entry. So we know that for a supplies adjusting entry, we're going to have to debit supplies expense, and we're going to do it for the amount of the adjusting entry, 1,240, and we're going to credit the supplies account, also for the same amount, 1,240, because we know that all of our journal entries balance. Even adjusting entries are journal entries, so they still have to balance. If they don't balance, your adjusted trial balance will not balance. So first we're going to post a $1,240 debit to supplies expense. Then we post a $1,240 credit to the supplies account. And we have now posted adjusting entry number 1. Now what we're going to do is we're going to adjust our prepaid insurance for 1 month of prepaid insurance that's been incurred. So the first thing that we're going to have to do is we're going to have to calculate the amount of prepaid insurance that has now been incurred. So we go to the account. There's $2,400 of prepaid insurance in the account, and we know that the prepaid insurance is for 1 year. So 1 month is 1/12 of a year, so we've incurred 1/12 of the amount in the account. So we take 2,400, we're going to multiply it by 1/12, and we get an amount of $200. That's incurred, and that is the amount of the adjusting entry. So for our adjusting entry, first we're going to debit insurance expense for the amount of the adjustment, $200. $200, 1/12 of that amount has been incurred, and then we're going to credit prepaid insurance for the same amount, $200, because again we know that our adjusting entries always balance. Every journal entry balance. Total debits always equal total credits. So first we go to the insurance expense account and we post a $200 debit to that account. Then we go to prepaid insurance. We post a $200 credit to that account. And we note that the balance in the prepaid insurance account is now $2,200, which represents 11 months in the future, and the insurance expense account represents 1 month of expired insurance. Alright, we've now gone through the second adjusting entry. Now let's go through the third adjusting entry. If you remember, we have a liability account called unearned rent. $360 is in that account. That represents 3 months of rent received in advance. Well, as of the beginning of December, none of that amount was earned, so the entire $360 is allocated to unearned rent. Now, after a month has passed, 1/3 of that amount has been earned, because again, the $360 was paid for 3 months in advance. So we're going to take the $360, we multiply it by 1/3, hopefully I'm going to type this correctly the first time, and we get a $120 adjusting entry. That is the amount of the revenue that was earned. We provided 1 month of services, so we're going to match that to 1 month of revenue. So the first thing that we're going to do is we're going to debit the unearned rent for the amount of the adjusting entry, $120, and then we are going to credit the rent revenue account again for the $120, because at this point, as of December 31st, we have only provided 1 month of rental services. So we're going to debit the unearned rent for $120, and we're going to credit rent revenue $120. Alright, we're now done with our third adjusting entry. We're now down to the fourth adjusting entry. We've provided $500 worth of services. In the book they talk about the number of hours and the contract, but as of the end of December, we have already provided 25 hours of services, and we have not yet billed the client for those services. So we've earned $500 worth of revenue that we have not yet received. Even if the client canceled the contract at this point as of December 31st, we would still be owed the $500, and those 25 hours of services were provided in December. So this is the first type of adjusting entry that we have. So all we do is debit accounts receivable for the $500, and we're going to credit fees earned because this was a contract for services. Again, our entries always balance, so that is going to be for $500 on the credit side. So we're going to go to the accounts receivable account. We're going to post $500 on the debit side to accounts receivable. That's that first line right over here. For the second line, we go to the fees earned account and we post $500 on the credit side. Alright, hopefully you're following along. Now we're going to go on to our fifth adjusting entry. Our fifth adjusting entry is, as of December, we have wages that our workers have earned, $250, that have been unpaid as of the end of December. So what we're going to do line spacing is incorrect over there. So what we're going to do for our wages that are unpaid at the end of December, once again, wages are an expense. So this is the first type of expense entry that we have, where we debit the expense account and we credit a payable account. We're going to go to our liabilities, and we actually see on our chart of accounts a wages payable. So since they've given us the amount $250, we are going to debit the wages expense account for $250, and we're going to credit wages payable for $250. So we're going to go to our wages expense account, a debit of $250 to wages expense, and a credit, that's right there, and a credit of $250 to wages payable. Now we have the final adjusting entry on the left-hand side, where we have depreciation expense. The amount of the depreciation expense is given to us, so for now just remember for depreciation expense that we're going to debit depreciation expense for the $50 and credit accumulated depreciation Again, since our journal entries always balance, we are going to debit accumulated depreciation for the same $50. So for our last adjusting entry, we are going to debit our depreciation expense, $50, and credit accumulated depreciation, $50. So our adjusting entries are pretty much like transactions because they are journalized and they are posted to the T accounts. Unlike transactions, though, they're never going to involve cash, because if an adjusting entry involved cash, it would be a transaction. The only time you may see an adjusting entry involve cash is from the bank reconciliation, if you find out that you have bank fees or something like that from your bank reconciliation. Other than that, if you already paid or received the cash, you would have known about it before the adjusting. Anyway, now let's calculate the correct ending balances in the accounts. So cash hasn't changed at 2065, but accounts receivable, we started out with 2220 and we added $500. Both are on the debit side, so that ending balance in the account is going to be the 2220 plus 500, which is going to be 2720 on the debit side. With supplies, we see a debit and a credit, so they subtract from each other. So our ending balance is going to be 760 on the debit side, which is exactly what adjusting entry A says, that the supplies on hand are $760. Our prepaid insurance is going to be $2,400 on the debit side minus $200 on the credit side, so the ending balance is going to be $2,200 on the debit side. Land is unadjusted, so we don't lose our land. That stays at $20,000 on the debit side. Office equipment stays at $1,800 on the debit side. We don't lose that. Now we have accumulated depreciation of $50 on the credit side. Moving on to the liabilities, accounts payable stays at $900 on the credit, wages payable $250 on the credit, but unearned rent we have $360 on the credit minus $120 on the debit is going to equal $240 on the credit side. Remember what I told you. It's as important to know what side an ending balance is on, whether it's a debit or credit. That's as important as the balance itself. Chris Clark Capital and Chris Clark Drawing only have one entry. On fees earned, we have $16,340 on the credit and $500 on the credit. Because they're both credits, they add to each other, so we have $16,840 on the credit side as our total fees earned. Rent revenue is $120. Wages expense, we have $4,275 plus $250, which is going to be $4,525 on the debit side. Both are debit, so they add and result in debit balances. Rent expense, $1,600 on the debit. Depreciation expense, $50 on the debit. Utilities expense, $985. Supplies expense, $800 debit plus $1,240 debit. They're going to add to each other for $2,040 on the debit side. Then we have insurance expense and miscellaneous expense. The final step now is to prepare an adjusted trial balance. So with our adjusted trial balance, all we're going to do is we're going to list all of the accounts that have a non-zero balance and their ending balances and see if we're going to balance. So you see here our cash has $2,065 on the debit side. Accounts receivable, final balance is $2,720 on the debit side. Supplies, the final balance is $760 on the debit side. Prepaid insurance, $2,200 on the debit side. Right there. Debit side in the T goes to the debit column on the adjusted trial balance. Land has $20,000 on the debit side. Office equipment, $1,800 on the debit side, but our next account, accumulated depreciation equipment, is $50, but on the credit side. So because that's on the credit side, that has to go in the credit column. Accounts payable has $900 on the credit side. Notice it's a credit balance, it goes in the credit column. Wages payable, $250 on the credit side. Unearned rent, the final balance is $240 on the credit side. Oops. Then we have Chris Clark Capital, $25,000 on the credit side. And we have Chris Clark Drawing, $4,000 on the debit side. Next we have fees earned, $16,840 on the credit side. Rent revenue, $120 on the credit side. The next account that we have after rent revenue is wages expense, $4,525 on the debit side. The next account that we have after wages expense is our rent expense, $1,600 on the debit side. Next we have depreciation expense, $50 on the debit side. Utilities expense, $985 on the debit side. Supplies expense, we don't care about the $800 and the $1,240. We care about the ending balance, $2,040 on the debit side. And we have insurance expense, $200 on the debit side. And finally, miscellaneous expense, $455 on the debit side. You're going to notice over here on our adjusted trial balance, we have $43,400 of debits and $43,400 of credits. Once we're in balance, we can be pretty sure that we've done everything correctly, and that is pretty much it for our posting and our adjusting entries. Now all we have to do is close the accounts and get ready for January. Okay, listen up for the next recording that I will have for closing entries.